personal finance.
Warren Ingram from Galileo Capital with our personal finance feature this evening. Now, I'm really torn, and you're going to have to explain to me why I shouldn't be torn, I'm sure. But the idea of incentivizing somebody to do well is well held in business. If you've got a team of people and you say, please produce 10 biscuits, and they produce 11, they should be given a little bit extra for producing the 11th biscuit. That's called an incentive. And they earn a bit more for doing it. And if they do 12 next week, well, then that's even better. You give them an even bigger incentive. Why are incentives, when it comes to investment portfolios, frowned upon in the way they are?
I don't think it's the principle of the incentive itself. I think it's more about that the fund managers it started really in the hedge fund space, but it's definitely moved into the unit trust space as well. They want to have their cake and eat it. So the way that they do that is they say we have a performance fee, and I'll come to how they structure those things. But if we don't do so well, by the way, we also do charge a normal annual fee, and so if we'll always make money. And I think that's where it starts to kind of stick in the throat a bit. Is how is it that they can charge fees actually in all instances?
And the defense there will be, it's not our fault if the general market sentiment is negative. If President Donald Trump does go bonkers and invades Russia, then markets are going to fall. That's not our fault. We shouldn't be punished for the actions of a crazy guy. And
so you shouldn't benefit either when the markets are doing incredibly well, and that just gives you a free ride up if you're the fund manager.
But then they talk about this thing called a benchmark. But there is the benchmark, and only if we outperform the benchmark by a certain percentage, then the incentive kicks in.
That's the incentive. But remember, they're still getting the annual fee. So if the whole market goes up, let's just say we're talking about a unit trust that invests in the stock market, and its benchmark is it must do better than the index. So if the index goes up 30% in a fantastic year, and this unit trust is charging 1% a year, and it doesn't do better than the index, it's still going to get the 1% a year, and it's still going to score. And it's actually done nothing. It hasn't added a cent of value beyond simply buying an index.
Okay.
And that's where the problem starts.
But this fund does 35%. It outperforms by 5 percentage points.
The idea there would be, if you're asking me for what's fair, what's fair is they then get paid for that 5% outperformance. Well done to them. That's great. But they don't charge an annual fee.
You see, and this is where I start getting cross, because now the market does 30% and you do 35%. More people look at your funds and go, oh, I want to invest with the guys who got 35%, not the 30%, because I'll get richer faster. So therefore, I'm going to put my money into that fund. And they draw lots more money, so they make a lot more 1% in their fees. That is ideally how they should be incentivized. Perform well, you stand out from the crowd, more people give you their money to run, you therefore get a greater pool of fees, and you become wealthier over time.
And that's great. Fair to everybody that you do that only on performance fees. The hedge fund market does it on a 2 and 20 basis. So they charge you 2% per annum, irrespective of what they're doing, whether they do well or not, which for me already feels like daylight robbery, 2% a year. Mm-hmm. And then they charge you 20% of their performance above that benchmark that you were talking about.
Now, the benchmark can be anything, right? The benchmark could be, our benchmark is 5% below what the market does, or 5% above what the market does, or it might just be the market.
Yeah, the ones that I don't like, the ones that I feel sort of a special loathing for would be in the flexible space. In other words, you get different categories of unit trust, and one would be equities, which means they only invest in shares. You get money markets. Then you get this category called flexible. And flexible is we can have 100% in shares, we can have 0 in shares, and put it all in cash. That's our choice as the fund manager. And you as the client, when you buy into my fund, you know I've got this complete range. My sales pitch to you, if I'm the fund manager, is I know when to put your money into the different asset classes. I know best. I can time markets, really. That's actually what they're saying. And so what they'll do is they'll say, my benchmark is the repo rate or cash. The STEFI is the name of the cash benchmark in the institutional space. So STEFI plus 1% or STEFI plus 2%. Now, in all honesty, if you can't beat a cash benchmark, if you can't beat a cash plus 2% a year, then and you just do that with shares actually, then you shouldn't be in the industry in the first place.
History teaches us if you invest in index funds, or you have invested in index funds over a period of time, you would have done on average probably 13% compounded over the last 13, 15 years?
Easily.
Okay.
And so cash, let's say cash is giving you 8% to be generous to the times when cash was a bit better than it is now. So you can do 2% above that. So let's just say it's 10%. So you're going to get 3 to 5% a year better than that. And you're doing nothing than just buying the index, but you're earning these massive performance fees on top of your annual fee.
No, but who allows these guys to charge performance fees? I do, because I sign a contract with them and says, and the idea of an incentive, because the better you do, the better I do. That's awesome. We're in this together. Go, buddy, go.
I'm your partner in life.
Yeah.
There we go. Yeah.
All of that.
I think that it is the investor. And unfortunately, what happens is that there's always a great sales spiel with this thing. So, you'll find the fund managers are also fantastic marketers. And remember, they're earning big performance fees, so they've got a big budget to do great marketing as well. Mm-hmm. And they're usually very charismatic people. They give fantastic presentations. And they'll stand up there and absolutely wow you with their performance in the past and why they know best. And so I can understand why people get in. And I'm not saying they get suckered. It's not, there's always disclosure, but they get drawn into this hype. And then they get part of the story, unfortunately. And it's not a great story always. Mm. And I think the problem with performance fees to me is, especially, if you look at the hedge fund space, the hedge funds will show you their track record over the last 10 years. And they'll say to you, per year for the last 10 years, we've beaten, whatever their benchmark is by 5 or 6% a year. We've, been outstanding performance. So that they, as you say, then they get a whole lot of investors' money. What's really interesting though is look at the performance, and it happened usually in the first 3 years of the fund's life. When they're tiny, they can take huge bets on very small, obscure little companies or obscure little investments that no reasonable fund manager of size can actually go into anymore. They get this great performance, then the flood of money comes in, and suddenly they can't buy those obscure little investments anymore. They have to go and buy the bigger companies, the bigger bonds, etc. And suddenly their performance really averages. But what they keep showing you is their per year track record for the last 10 years. And you keep saying, wow, that's incredible.
And their per year track record for the last 10 years is inflated by the spectacular performance of the first 3 or 4.
That's exactly right. So you get this great return, and it's not on a huge pot of money in the beginning. That's what bugs me.
Have you got any questions for Warren Ingram on performance fees? 021 446 0567 011 883 0702, or you can SMS. Then I'd argue, says somebody on the SMS line, their performance fees on equities be structured as follows. A basic fee of, say, 8 basis points equivalent to the fee on passive funds, a performance fee percentage on a rolling period of 3 years and capped. So it's not a year-by-year thing. Show me long-term performance of this fund, and then we can start talking about sharing some of the spoils.
Okay. I have a small problem with the first part. I think you should earn zero. The starting point is you earn nothing. You only earn a performance fee. If there are fund managers out there charging that way, I think that's extremely fair. And I don't mind then if they take a disproportionate amount of, in other words, they don't cap the fee to such a small amount if they do well. That's great, because it is quite hard. I mean, history shows us that out of every 10 fund managers, only 2 are going to beat the all share index. So I'm not saying that it's an easy job to do that, but then you've earned your money, and well done to you. And I think it is a good idea to do it over a longish period of time. In other words, don't say that you get the performance fee if you've only beat the index over 1 year, because you're probably taking quite big bets to do that on a year. But if you're doing it over 3 years consistently, then that's an element of skill. You're displaying skill and looking after your investors. I like that.
Ismail is asking the most pertinent question of all, because it is one of these great bull dust industry things where they talk about a thing called a total expense ratio. So now I look at those 3 words. There's the word total, which is everything, and there's expense, what it costs, and it's a ratio. And so it's the amount of money you spend to get a return.
Yeah.
In total. But it's not.
No, in fact, now they've actually expanded that now to a thing called the total cost ratio. So that now includes brokerage and those things which were excluded out of the total expense ratio in the beginning because the fund managers were complaining and saying it was, very hard to actually compare apples with apples. And so now they've got this total cost ratio. And I think there'll be additional disclosures coming through. There already are, in fact. I think there's one called the annual expense ratio or something like that, which is a bit better measure. So the measures are getting better. But he's right. I mean, the total expense ratio is not really the thing that it says it is.
And that's also, it's been allowed to sort of cement in people's minds, and people think, oh, it's 2% or whatever. That's okay, because that's everything. But actually, you paid a financial advisor, you paid a broker, you paid the fund manager, and those expenses add up to more than the total expense ratio, because it's more than that. Simon Brown from Just One Lap. He can't leave us alone. Hey, Simon Brown.
How's it, guys? I can't leave you alone. Quick point. If they're going to charge a performance fee, when they underperform, they must give the performance fee back. Then we're aligned.
I would agree with you, but that doesn't work like that, does it, Simon?
No, it does not at all. No one does it. But otherwise, it's asymmetrical. They win when they lose my money, they have no pain. They still go and drink sparkling wine.
Simon, your line is absolutely awful, but your point is spectacularly made. Thank you, Simon Brown.
Do you know why his line's awful? Because I'm sure he's on the hands-free in his little dinky car that has no soundproofing. That man doesn't spend money on cars.
Because he's your kind of guy. He's your kind of guy. He's a parsimonious kind of fella. He's more interested in watching money grow than spending it.
Okay, so I don't want to be completely one-sided. So just to give the counterpoint to that, what they do, the companies that charge performance fees, they talk about something called the high watermark. In other words, if you gave us 100,000 rand and the stock market went down and it lost 30% and your fund lost 20%, the next year you've now got 80,000 rand and we suddenly get you back to 100,000 rand. They're not going to charge you a performance fee for that jump from 80,000 to 100,000. Even though it is quite a big jump, they'll only start charging a performance fee once you've actually made more than what you originally put in.
You see, and this begins to offend me as well, because I look at that. So we're now 2 years down the track. We've had 2 years of 6% inflation. The 100,000 I gave you 2 years ago in real terms is now worth 87.5 or 88,000 rand in my 2 years ago money. I'm still down. And you're still going to charge me a performance fee.
If you're not charging an annual fee, then I think it starts to get a bit fairer. And remember, it's a rolling period, so they're still going to have to do something. They're still going to have to get a bit more growth.
Okay, a related but unrelated question, Nicholas. A quick question from you, please, on retirement annuities.
Yes, how's it going?
Good. Quick question, please.
Cool. So I've got a RA with Sun, and I'm busy doing an exercise now to move over to Discovery. We've got a medical aid there with Vitality. So I understand that if you cancel a RA from one company and move to the other company, there's a penalty. But Discovery is offering all these amazing packages and boosters. And I just want to know whether or not something like that long-term is worth it or not worth it.
Nicholas, I think it may be a topic for an entirely different day, the complexity of moving retirement annuities, because it's about platforms, it's about competition. Can you answer the question simply?
So I think that it's a good point to say that you need to find out what that penalty is, and I have heard that these companies are now offering to top up that penalty that you've paid to move across. What I don't understand is how on earth are they're recovering that money that they've paid? Because if they're paying an upfront fee to the investor who's now lost money on the other side to come in, they're not doing that for fun. I mean, these are investment companies and insurance companies. They've got teams of actuaries there, and these guys all want to get paid their big bonuses. So what's not clear to me is exactly the intricacies of this thing. But he's not wrong. I have seen those offers being made.
Okay. Do you need a week to think about it?
The issue is we probably need to get someone in, and he's going to speak Greek to us to explain it to us. But
can we promise to revisit Nicholas's question?
Yeah.
At some point in the not too distant future in English, as simply as possible, because the complexity of people you might be sitting in a retirement annuity that is underperforming the benchmark, and there's no reason why you should be stuck to that retirement annuity. You should be able to move from an underperforming investment to one that you believe will perform better.
Let's do it. Let's do it next week.
You see, that's what I like. Nicholas, look what you've done. Warren Ingram is committed to next week. We'll talk retirement annuities and the complexity around that, because especially in a low growth environment where competition between investment houses is going to become that much more intense, a lot of people are going to be very tempted to move. And it may be the right thing for you to do, but at the same time, sometimes the best thing to do, Warren Ingram, is
Stay the course.
Stay the course. Do nothing. Warren Ingram from Galileo Capital.